Hey everyone, Joni AG here. I need to confess something before we go any further. I've been analyzing what happened over the last 12 hours, reconstructing the sequence, examining the mechanics, studying the behavior patterns, and it's worse than I expected. Because what most people saw yesterday as a normal pullback, as healthy profit taking, as natural volatility in an extended rally, I saw as something completely different. I saw as a survival maneuver, as a defensive action. As price being forced down, not because sellers wanted out, but because someone needed it down. Silver tagged $92, dropped over 6% in minutes, violent aggressive selling that felt wrong, then snapped back near $91, recovered almost as fast as it fell, and now it's hovering around $90. Most people see volatility, see the chart going up and down, see normal market behavior. I see a trap, a mechanism, a signal that something beneath the surface is breaking. And today I'm going to show you clearly, simply, without hype or conspiracy theory, why the move to $86 overnight wasn't random, wasn't just traders taking profits, wasn't natural market dynamics. It may have been necessary, may have been required to prevent something worse, may have been the only way to avoid triggering events that would have forced the entire structure to reprice violently. Quick disclaimer, because this matters, this is not financial advice, this is market structure, education and macro analysis, documenting unusual price behavior and what it might reveal about underlying stress. I'm not telling you to buy or sell anything. I'm not recommending positions or strategies. I'm not claiming I know with certainty what caused yesterday's move. Do your own research and consult qualified professionals before making investment decisions. What I am going to do is walk you through what the mechanics suggest, what the physical signals reveal, why certain price levels matter more than others, and why this might be the beginning of something much larger rather than the end of the rally. Now watch the behavior, not just the price. Don't just look at the chart. Look at what the chart is telling you about who's in control and what they're trying to avoid. Let's reconstruct the sequence. Let's walk through what actually happened step by step so we understand the pattern. Silver pushes into the $92 zone, testing resistance, building momentum, looking strong. Then suddenly, without warning, without obvious catalyst, violent dump, 6% plus in minutes. Not gradual selling, not orderly profit taking, aggressive forced liquidation style selling that moves price discontinuously. Then almost immediately, rapid recovery. Buying comes in, price snaps back, recovers most of the losses, and now we're stuck in the $90 neighborhood, oscillating, consolidating, testing levels. If this was a normal stock, if this was equity market behavior, you'd say profit taking. You'd say traders booked gains at resistance. You'd say healthy consolidation before next leg higher. But in leveraged commodity markets, in futures markets with margin requirements and position limits and forced liquidation mechanisms, sudden drops like that often mean something different, often mean someone is trying to avoid a trigger, trying to prevent price from reaching levels that force mechanical responses. Because certain prices aren't just technical resistance, aren't just round numbers that look significant on charts. They're margin levels, they're thresholds where exchange rules change, they're trigger points where forced actions begin. Why does $100 matter? Why is that specific level so important that someone might need to prevent price from reaching it? Here's the simplest version without complicated derivatives mathematics. When a market is heavily leveraged, when participants are using borrowed money to take positions, when futures contracts allow controlling large amounts of metal with small amounts of capital, there's a point where margins rise, where exchanges require more collateral, where participants must either post additional cash or close positions. That's not opinion, that's not speculation, that's mechanical. That's how exchanges manage risk. And I'm not claiming I have any bank's internal position book. Can't tell you specifically who's short and by how much. Can't name institutions or reveal proprietary information I don't have access to. But I am saying this, and this is observable market structure. If a big player is on the wrong side of a fast move, if they're short when price is rallying, if they're betting against silver and it's going against them, and price crosses certain levels, psychological barriers, round numbers that attract attention, levels where margin requirements increase significantly, the market becomes a liquidation machine, becomes a forced buying engine, becomes a gamma squeeze or short squeeze scenario, where rising prices force covering, which causes more price rise, which forces more covering. That's the feedback loop. That's the mechanism that can turn orderly markets into explosive panics. And that's why $100 matters psychologically and mechanically. Round numbers matter. Triple digits matter. Breaking through barriers that haven't been touched in generations matters. When silver crosses 100, when it prints 3 digits, media coverage changes. Retail attention explodes. Institutional risk management gets triggered. Margin requirements get reviewed. The game changes. Now in the silver niche, In the precious metals community online, a huge number keeps circulating, gets repeated constantly, gets used to explain why silver must go higher. Banks are short 4.4 billion ounces. Annual production is only 800 million ounces. Therefore, the short position is 5.5 times annual production. Therefore, covering is impossible without massive price increases. I want to be responsible here. Want to be honest about what we can and cannot verify. That exact 4.4 billion ounce figure isn't something we can verify cleanly from public commitment of traders' reports or exchange data. So treat it as an estimate circulating in the niche, as a number that gets thrown around by silver advocates, not as a proven official statistic you can cite with certainty. But here's what matters regardless of the exact number. Here's what's true, even if that specific figure is inflated or misunderstood. Paper exposure can be multiples of physical flow. Derivatives markets can create positions that far exceed available supply of underlying metal. Futures contracts can be written that promise delivery of more silver than actually exists in deliverable form. That's not conspiracy. That's how these markets work. That's the entire point of leverage. And that's why markets like this can flip from price discovery to stress event instantly, can move from calm, orderly trading to explosive volatility when too many participants try to access physical settlement simultaneously. Here's where the trap lives. Here's what most people miss when they look at yesterday's price action. Most people saw the drop from 92 to 86 and thought the rally is over, thought this was the top. Thought it's time to take profits or get out or wait for lower prices. I saw the drop and thought they had to dump it, had to force it down, had to prevent it from continuing higher. Because if silver had cleanly ripped through 92 and then sprinted to 100, if it had broken that psychological barrier, if triple digits had printed, the margin engine could have turned on. The forced covering could have begun. The feedback loop could have started. So the question isn't why did it drop? The question is why did it drop so fast, so sharply, so violently at the exact moment the market was heating up? Why did the selling appear suddenly rather than gradually? Why was it concentrated rather than distributed? Why did it reverse almost immediately rather than continuing to cascade lower? And the answer is often one word: liquidity, or more precisely, the lack of it. If you want to move price with less resistance, if you want to force markets to levels they wouldn't naturally reach, you do it when the market is thinner, when fewer participants are active, when order books are less deep. Low liquidity means fewer resting orders, fewer bids protecting downside, less cushion, less absorption capacity. That's why some of the ugliest moves happen overnight, why sudden gaps appear during Asian trading hours or European morning sessions when U.S. market participants aren't active. Why price can move more dramatically on smaller volume during thin trading windows. So a violent drop out of nowhere during low liquidity period that reverses quickly can be a tell, can reveal that someone pushed hard when the book was empty, when there wasn't enough natural buying to absorb the selling pressure. Again, this is not a conspiracy claim, not alleging manipulation by evil market makers. It's a market mechanics reality. It's how order books and liquidity work. It's observable behavior that happens across all markets. Now here's where the story gets real. Here's where we move from price action to physical fundamentals. If the sell-off was a healthy correction, if it was natural profit taking, if it was just traders booking gains after a big run, you'd expect physical conditions to ease, you'd expect premiums over spot to compress, you'd expect dealers to report easier sourcing, you'd expect industrial buyers to report improved availability. But what we're actually observing is the opposite pattern, the opposite signals. Lease rates and borrow costs stay high. The cost to borrow physical silver, the rate you pay to obtain metal for short-term use, is rising rather than falling. And the futures curve is hinting at backwardation, starting to show signs of inversion. Let's translate backwardation into plain English because this concept matters and most people don't understand it. Normal futures curve is contango, means future prices are higher than spot. Makes sense because holding physical metal has costs. Storage costs, insurance costs, financing costs. So future delivery should cost more than immediate delivery. Backwardation is the opposite, means spot price is higher than futures, means the market values immediate delivery more than future delivery, means people don't want a promise to receive metal in 6 months. They want the metal now. They're willing to pay premium for immediate access. That's not normal calm behavior. That's not how markets trade when supply is adequate and demand is patient. That's stress. That's urgency. That's industrial buyers and physical market participants saying we need metal now, regardless of cost. Now let me connect the dots. Let me show you why the math becomes terminal, why this situation has no easy resolution, why price must ultimately adjust to physical reality, supply is limited, silver comes from mines Mining takes years from exploration to production. You can't just decide to produce more silver next month because price went up. Supply response takes time. Recycling, the other source of supply, dries up when people hoard. When holders believe prices are going higher, when they think silver is valuable insurance against system instability, they don't sell into rallies. They hold. They remove supply from the market. Industrial demand is inelastic. This is critical. Inelastic means factories don't stop buying because price increased. Don't stop production because silver got expensive. If silver is a small fraction of total manufacturing cost, if it's 5% or 10% of total input costs, and stopping production means missing revenue that's 20 times larger than silver costs, they pay up. They buy at any price. Because stopping production destroys revenue, breaches contracts, loses customers, damages reputation. The cost of not having silver exceeds the cost of expensive silver. So the real question, the question that reveals why this is unsustainable at current price levels, becomes this. Where does the metal come from if everyone wants it at the same time? If industrial buyers need it, if investors want to hold it, if short sellers need it to deliver against contracts, if retail buyers are stacking coins, if sovereign entities are accumulating strategic reserves, where does the metal come from? And that's why I call this a reprice environment, not a rally. Not a bull market in the traditional sense. A fundamental adjustment where price discovers the level that actually balances supply and demand when supply is constrained. Now let's talk about the scary phrase that makes people nervous. Force majeure. People think force majeure shows up as a clean announcement, as official press release saying we cannot deliver, as dramatic confession of failure. No, that's not how it works. That's not how systems admit inability. Force majeure usually starts as soft behavior changes, as subtle shifts that most people don't recognize as significant. 6-week delivery delay instead of next day. Unavailable for volume orders instead of unlimited liquidity. Call for pricing instead of posted premiums. Widening premiums where dealers charge more and more over spot. Settlement flexibility where contracts that specified physical delivery get modified to allow cash settlement. Quiet rule changes where exchanges adjust procedures without fanfare. That's the system buying time. That's institutions managing stress without admitting crisis. And you're already seeing the early version. Wholesale delays, longer lead times. Physical stress signals. Dealers saying metal is available but delivery takes longer. Premiums staying elevated despite paper price corrections. The gap between paper reference and physical access widening. This is the core framework for understanding what's happening. This is the lens through which you should view all price action going forward. We're watching a split into two markets, a bifurcation, a divergence. One, screen price, the algorithmic paper reference, the number you see on financial websites and trading platforms. The futures, quote, the spot reference that derivatives trade against. 2, street price, what it actually costs to secure real metal in size, in proper form, with time certainty. What industrial buyers pay, what dealers charge retail customers, what you discover when you actually try to convert paper exposure into physical possession. When those diverge, when the gap between paper reference and physical access widens, it becomes harder for the paper market to control the story, becomes harder to maintain the fiction that paper exposure and physical access are equivalent. Because paper can quote whatever it wants, can show whatever price algorithmic trading and futures positioning generate. But availability is physical, reality is physical, delivery is physical, and you can't deliver paper silver to a factory that needs actual metal to manufacture products. This is the part people underestimate. This is the dynamic that changes everything about the narrative. Ordinary people aren't showing up to silver right now because they want to trade, aren't buying coins to speculate on short-term price moves, aren't trying to time entries and exits. They're showing up because they want something that can't be printed, that can't be hacked, that can't be shut off. And yes, this line hits hard because it's simple and true. Buy one silver coin, hold it. They can't print it, hack it, or shut it off. It's not about glamour, not about getting rich quick, not about outperforming the stock market. It's about autonomy, about having something real in a world that increasingly feels fake, about insurance that doesn't depend on counterparty performance, about wealth that exists physically outside the financial system. What am I watching next? What signals tell me whether yesterday's dump was the end of the move or just a shakeout before the next leg? Here's the clean checklist for the next few days. 5 things that matter more than daily price. First, does silver reclaim and hold above $92? Does it break back through the level where it got rejected violently? If it does and holds, that confirms the dump was temporary defensive action rather than fundamental change in direction. Second, do physical premiums stay elevated even if paper price dips? If dealers continue charging significant premiums over spot, If retail coins trade at 95 or 98 when spot is 90, that confirms physical tightness regardless of paper positioning. Third, do lease and borrow costs stay high? If the cost to borrow physical silver remains elevated, if rates don't compress back to normal levels, that confirms stress in the lending market. Fourth, does backwardation persist or deepen? If spot continues trading at premium to futures, if that inversion strengthens rather than resolves, that's powerful signal of physical urgency. Fifth, do we see more sharp drops in thin liquidity windows? If price gets smashed again during overnight sessions or low volume periods, that confirms someone is actively defending levels rather than price declining naturally based on fundamentals. If those signals persist, if physical stress remains, if premiums stay high, if backwardation continues, if defensive price action repeats, then the dump wasn't the top. Wasn't the end of the move, it was a shakeout, was an attempt to prevent price from reaching levels that trigger forced responses. Now I want you to comment one word in response to this analysis. Either trap or reset. Trap if you think it's a final shakeout before the next leg higher. If you believe someone is desperately trying to prevent $100 from printing. If you see yesterday's violence as confirmation that shorts are trapped and price must ultimately resolve higher. Reset. If you think the system has fundamentally changed, if you believe paper price is falling behind physical reality, if you see this as the beginning of permanent bifurcation where derivatives and physical trade as different products, then give me one sentence explaining why you chose that word. Because your answer reveals how you're interpreting the structure, whether you see continuation or change, whether you think we return to normal or enter new regime. Let me address the obvious counter. What if I'm wrong? What if this analysis is completely off base? Here are the two ways I could be mistaken. First, physical conditions ease fast. Premiums collapse back to normal. Lease rates drop. Backwardation disappears. Delivery times shorten. That would suggest the stress was temporary, was overblown, was not as severe as the signals suggested. Second, demand cools temporarily, and the curve normalizes. Industrial buying pauses. Investment demand fades. Retail loses interest. Short covering completes. Market returns to balance. But if backwardation and lease rates remain stressed, if physical conditions stay tight, if premiums persist despite paper price corrections, the market is telling you this is not normal, is telling you something structural is breaking, is confirming that the two-market framework is real. Now let me be brutally clear about what's really happening here. The drop from $92 toward $86 wasn't nothing. Wasn't meaningless volatility, wasn't just normal profit taking. It looked like the market signaling someone is afraid of $100. Someone needs to prevent that level from printing. Someone is defending that barrier. And the physical signals didn't confirm relaxation, didn't suggest that the dump released pressure, didn't indicate that stress subsided. That's why this matters. That's why understanding this pattern is critical. Because the next time price pushes back through 92, and it will, the next time momentum builds toward triple digits, and it must, the move may not politely stop at 100. In stress regimes, in markets where physical constraints are binding, where delivery becomes questionable, where too much paper exposure chases too little physical supply, markets don't climb gradually, don't respect technical levels, don't give participants time to adjust. Markets jump to the level that rations demand, jump to the price where marginal buyers finally back away, jump discontinuously because the adjustment happens through crisis rather than through gradual rebalancing. Here's the summary. Everything you need to understand about what happened and what it means. Yesterday's move wasn't just volatility, wasn't random, wasn't meaningless. It looked like survival mechanics, looked like forced action, looked like someone desperately preventing price from reaching levels that trigger cascading effects. Physical signals didn't calm down, didn't confirm that selling was natural, didn't suggest stress released, lease rates high, backwardation forming. Premiums persistent. Two markets are forming, paper versus access. Screen price versus street price, derivatives versus delivery. And $100 is not just a number, not just psychological barrier, not just round number that looks significant. It's a trigger, it's a threshold, it's a level where mechanical responses begin, where margin requirements increase, where attention explodes, where the game changes. Ladies and gentlemen, Joni from Bullion Alarm here, the Asian guy. Welcome to the commodity supercycle. Welcome to the moment where decades of assumption about how silver markets work get tested, where the relationship between paper and physical gets stress tested, where we discover whether derivatives can continue dominating price discovery when physical access becomes the constraint that matters. If you want real-time updates, if you want continued analysis as this develops, like and subscribe. Turn on notifications and comment. Answer the question, tell me your interpretation. Trap or reset, one word, one sentence. Because that conversation, that debate, reveals how people are processing this moment. Reveals whether they see temporary obstacle or permanent change. Reveals whether they believe in mean reversion or regime shift. I'll see you in the next one as we continue tracking this historic repricing and documenting the moment when silver's paper market and physical market possibly, finally, irreversibly diverge.